it's time to go on, because now we were able to arrive to the C part of the appendix. So we will start to deal with forward and future contracts valuation, and after that we will start to check what is inside the next chapter, because right now this seems to be more appropriate ordering, because okay, after dealing with discrete and continuous compounding, and we realize that continuous compounding is much more easier from from a modeling point of view. And also when we realize that okay, how can we compute future value this way, and also we realize that okay, it can be useful for evaluating bonds as well. Now we can say that okay, let's define future prices when we have absolutely no income at all. So we can say that okay, if the future value of some kind of asset today is, let's take today's spot value, and then let's just take its compounded interest, so with the R, with the time in years, so annual interest rates, annual, okay, sorry, time in years, then it's on X, and after that we just have to multiply this one, and yeah, today we will see this again. So when we have to talk about expected value in the future from a spot price, then it will be practically the same like this one. But what is happening if some kind of income is realized, so let's say dividend in the future, then we have to take this income from, or we have to deduct this income from the spot price, and the same thing will be used. And after that, what is happening if it pays any kind of interest like entity at rate of Q, then we can say that okay, this one must be also taken as a minus. And that's why if we have foreign exchange rate, then we have to take also the difference. So this is where we can find the what is that? Interest rate spread. So the sovereign spread will come here. What we can remember from international finance long time ago, that spot rates are always following the sovereign spread, at least the real sovereign spread. Then this is what is coming back again. Just in this case, we can say that okay, the domestic one is not highlighted here, so this one is the domestic, this one is the foreign, and with time t. And of course, what is the value, the right to buy at an asset, the price, the future price? Then we can see that this will be, so the price key or the right to sell value will be back and forth. Yeah, so let's build up these things from the ingredients. So in Matlab. Risk Management Lecture 3. So C part futures, because after that we will you're using these building blocks, or some parts of these building blocks today. So anyway, we should introduce them. So let's say F equals let's call it F S0 multiplies. In this case we have to use the exp function. That's the same in Excel as well. So nothing new is happening here. R multiplies t. Let's copy this thing here. So let's say r equals 0.1. Free domestic interest rate t equals 1 years, assume 0, let's say 100. Spot rate and future value. I don't want, I would like to see inside. So in this case, yeah, it works nicely. Yeah, we could use future value pricing, but just in this case I would like to see the components, because later on we will be building from this component, so using functions would be strange, or at least this will be the next step. So. Okay, asset provides income during the life of the contracts has a present value r. So I equals 10. Then its future value will be, if they are paying any kind of money, then this value is decreasing. If they are providing any kind of rate, then this must be compensated. Okay, it cannot be 0.1, so let's say 0.2, 0.02. Is it bigger? Yeah, it cannot be bigger. We decrease this one, so yeah. And after that, buy a future or whatever future forward contract where the holder has the right to buy the asset at the price of K. So K 20. Then this will be F minus K multiplied with okay, we already had this setup. Yeah, and now this is the value of this contract. Cool. Okay, let's have the other option here, and after that we have all the ingredients. I never like when they are changing the orders, so yeah. Let's keep the orders stable and just changing the signs. Cool. So these are the building blocks.